Okay. Hi, everybody. I was just connecting to Instagram, so I missed a few seconds. I missed you there. For those of you who are on already, welcome to my channel. My name is Mike Patel with Home Service Central. I'm in Orange County, California, and it's nice and sunny and hot today. I'm actually feeling really hot today. The AC is going, but it's not quite cool enough yet. We have a great topic today, a very, very relevant topic, very, very important topic. So important that this topic or what's going to happen with this may change the way the housing market has been going. And that has to do with the interest rates, not only the housing interest rate, but the federal funds rates, because everything depends on the interest rate, the banks that borrow from each other, your credit cards, your auto loan. And of course, that may impact the housing interest rate also. So we have a lot of things. We're going to talk about some scenarios, what ifs, what's going to happen to the housing market, prices depending on the interest rate. And to help me do that, I'm no expert in interest rates or in lending. I have a good friend of mine all the way from Atlanta, Kevin Jefferson. He is on here. Kevin, introduce yourself. Thanks for coming back again. And thanks for coming here. I know you're in Atlanta, so yours is 8 p.m., so I really appreciate it.
No problem, Mike. I'm Kevin Jefferson, better known as the People's Lender. I am a mortgage loan officer, been in the business for 9 years, and actually excited about what may be about to transpire.
Great, great. Yeah, we have a very exciting topic. And the FOMC is having a meeting today, and we should have the results tomorrow. Is that right? Uh,
Yeah, we should have some results on tomorrow as to what they're going to do.
right, right. So to get started, I also have a TikTok channel and I get questions all the time. What's the difference between the federal funds rates and the mortgage rates? And they say, well, if they drop the rate, will our housing rates go down? So can you take somebody, let's say I'm a brand new buyer or a seller, I don't know much about federal funds rate and the mortgage interest rates, what the connection is and what happens, and who uses the federal funds rate? Who is it for, if not for housing? Just kind of give us some scenario on that.
Right. So the federal funds rate is the rate that the Federal Reserve provides, right? So the Federal Reserve, when they lower interest rates, they lower interest rates and it has an effect on student loans, car payments, credit cards, home equity lines of credit, right? What it does not have a direct effect on is the mortgages, right? The mortgage industry. The mortgage industry is backed by the 10-year treasury bond. So while there is sometimes a correlation as to interest rates dropping on the mortgage side, sometimes it's not. It's in a reverse effect. So like right now, we're at a 12-month low, which is essentially exactly where we were last year.
You're talking about the
Like
federal funds rate. That's low,
the
12-year low.
the actual mortgage interest rates are the 12-month low.
Right.
So we're exactly where we were this time last year, right
Mhm.
before the Federal Reserve dropped interest rates.
Right, right. Okay, cool. Yeah. So, so I'm going to show a screen here. It shows the correlation or non-correlation, whatever you want to call it, between the federal rates and the mortgage rates, right? So if we look over here, can you see the screen here?
Yes.
Let me see. Okay. So basically, what we want to understand, of course, myself and the viewers and that are watching, it doesn't mean that just because the federal funds rate lower, that means the housing mortgage will go lower, or if the federal fund rate goes higher, the housing mortgage will go lower. Um, if you look over here, if you go back over here, if you can see it in 20, it kind of follows, but it's not always the same, right? Let me see if I can get a better screenshot here. Go back to the federal funds rate and get a 5-year, get a more understanding. Let's see. Can you see that now? It's a 5-year. So, for example, over here, back in 2018, right here, the federal funds rate went up and the housing mortgage went down. So it doesn't always follow, correct? I mean, it's not always parallel or in sync, right?
Correct.
So what causes it to be different?
So example, right now, I said, hey, we are at a 12-month low, knowing that the market and that there's likely going to be a correction, not a correction, but a decrease of the Federal Reserve rate, and the 10-year Treasury bond is constantly getting lower. We've already seen interest rates drop. Like where mortgage companies typically hedge ahead of that if there's any type of correlation. Let's talk about prime example of last year. I said this time last year we're in the same position, right?
Right.
However, last year in September, when the Federal Reserve dropped interest rates 0.25%, there was probably a 2-week window where rates dropped. After that, interest rates went up.
Okay.
So right now, most mortgage companies have already embedded the price drop in mortgages.
Right.
So when the Federal Reserve makes the change or decides to go down a quarter tomorrow, and maybe they go down a quarter in October, there's no guarantee that mortgage interest rates will go down. One thing that is happening is that we're a little bit lower in, if I'm not mistaken, I believe that not interest rates, but inflation is a little bit lower now than it was this time last year, which is why everybody is saying, hey, you dropped rates twice last year and inflation was higher. Why aren't you dropping it now?
Exactly. Right. Okay. So there's a big push. One, all the buyers that I know of want the interest rate dropped because the homes become more affordable. But to be realistic, it doesn't really make a lot of difference, right? I was listening to a podcast today and they said, okay, if the interest rate is 6.25 and if it drops to 6%, how much more affordable is it going to be? Not really that much. A couple of $100 on an average home of $400,000. It's not really that significant. At the same time, with the home prices that they are, if the rates drop, and we'll talk about it later, what are the 3 scenarios that's going to happen with the rate drop or up? So we'll talk about it, but there's really not a significant difference. Unless you have a point and a half, 2-point drops, we'll see a significant difference. But what I want to get to is why this meeting so important. One, about 2 or 3 weeks ago, like you mentioned, the rates already dropped to 6.29% because of the treasury bond went up or down, and the lenders already reacted to it. The 2 reasons, very important. Tomorrow we'll have the announcement. The meeting is going on today and it'll continue tomorrow, and I believe 2 p.m. Eastern time they're going to announce what they decided. So the 2 important things is, one, is the rates going to drop by how much, right? And number 2, our administration, Trump, has been really pushing him, and I'll show you an article. He wants 3 basis points dropped. He's been pushing and shoving and taunting. And of course, I'm not getting political. I'm strictly giving you the facts. He's been pushing him to drop, pushing Fed, specifically Jerome Powell, who has threatened to fire, but that's another story. My question is, why does the Trump administration want 3 basis point drop? What's the significance of this? I have no idea on that. Do you have any idea why?
I don't.
Okay.
And again, like you said, Mike, I'm not trying to make it political at all.
Right. Yeah.
I honestly don't think they understand that they don't work together.
Right.
Like the mortgage interest rates and the mortgage interest rates and the Federal Reserve dropping their rates don't work together. And I don't think they understand that they don't go together. Now, example, I remember during COVID when the interest rates for the Federal Reserve was 0.
Mm-hmm.
And
0. Okay.
I never forget that people thought that meant 0% mortgage interest rates.
Mm-hmm.
So it was, like, I don't think people really understand that they're 2 different things. All they hear is interest rates, right? They
exactly.
hear,
that's why I wanted to clear this out so that
Yeah,
Yeah.
all they hear is interest rates, but it's not 0% mortgage interest rates. Now, to if I had to take an educated guess, dropping mortgage interest rates 3 basis point, excuse me, dropping the Federal Reserve 3 basis points would potentially free up cash for a lot of people.
Right.
Meaning that allows people to refinance cars,
Mm-hmm.
student loan debt,
Right.
home equity lines of credit, which lowers payments and increases cash flow for people with those situations.
Right.
That's when it would make sense. But
Right.
dropping them 3 basis points and seeing if mortgage interest rates would go down, that doesn't work. But it does free up capital for people who
Right.
have the ability to refinance one of those type of loans,
Yep.
credit cards and all. Yep.
Right. Yeah. Let me put another screen on there. Let's talk about that. I'm going to stop this screen share, add another one. CBS. Where is CBS? Google Federal. Where is CBS? Let's try this one. Okay. So this chart here, it's from the CBS News. It shows here the U.S. average 30-year fixed rate mortgage. Now it's going back 5 years. Okay. Right now it's at 6.4. This is as of July, probably as of August. So it's, not day to day. The highest we've seen is up to 7.8%, almost 8% back in September, October. I'm going to read out. President Trump has flagged high mortgage costs as a reason why the Fed should cut rates. But by the way, can you see the screen, the chart that I'm talking about?
I see the chart. The words are small on my end.
Right, the words are small. It's the website here. Let me see if I can make it bigger here. Okay, a little bit bigger. Okay, and there's ad running here, but I can't do anything about that. So it says here that President Trump has flagged high mortgage costs as a reason why the Fed should cut rates. Okay, but mortgage rates are determined by more than Fed's benchmark rates, such as strength of the overall economy and the 10-year Treasury bill. So this is an article as of September 11th. So it's pretty recent. But mortgage rates are determined by several factors beyond the Fed's benchmark rate, including the strength of the U.S. economy and the 10-year note. Already, rates have declined in recent weeks, dipping to 6.35% for the week of September 11th, in anticipation of the Fed's cut and weaker economic data, which the cuts should be coming tomorrow around 2 o'clock Eastern time, I believe. Even so, a rate cut could help some consumers by lowering their borrowing costs, experts say. Let me read one more paragraph and we'll discuss it here. A declining interest rate environment will provide some relief for borrowers, bank rate financial analyst Stephen Cates said in an email. Whether it's a homeowner with a 7% mortgage or a recent graduate hoping to refinance student loans and credit card debt, lower rates can ease the burden on many indebted households by opening opportunities to refinance or consolidate. What's your take on that?
Kind of like I had just said, lowering debt any way you can is essential with the rise in inflation. So let's say a person purchased a car 2 years ago and they have the ability to refinance, they may be able to get a lower rate and save them $100 a month.
Right.
So some people say, oh, well, that extends the term of the loan, possibly. But, are we, and it's this time, like, are people more concerned with, freeing up $100, which makes a difference between them possibly keeping their lights on and saving their home, or are they concerned with extending it and paying it a little bit more? Students, with student loan debt, consolidating that debt and getting a better interest rate, that's,
Right.
That's going to help for those that are paying back. And,
Right.
People who took up home equity lines of credit, it may save them a point.
Yep.
If it save them a point, that's significant savings, because on a home equity line of credit, they're typically paying interest only. So that's let's say $150 less they're paying in interest that they can apply to principal without changing their payment.
Okay. Yeah. Yeah. So So now, how does the, I was, like I said, I was listening to a podcast today, and what he mentioned on his is that if somebody has a HELOC, a lot of them had a HELOC, right? They refinanced or they pulled money out so they can go on a vacation or remodel or do whatever. Let me turn this off. Let me remove this here. There you go. So a lot of people got the HELOC back in 22, 21, 23 at lower interest rate, right? And then what happened was in 23, the rates jumped. I did the same thing. My payment on a HELOC I had an $80,000 loan, and my payment interest only was $400 back in 2022. All of a sudden, when the rates went up to 8%, my payment jumped to $1,000. The same mortgage, because my HELOC went from 4% to 9%. Because as you know, HELOCs are not fixed. They're interest only payments, and they're tied to either CPI or LIBOR or whatever. So mine was tied to whatever federal funds rate. So it went in about 3 or 4 months from 400, it jumped to 975 or whatever. Luckily, I had some money coming from somewhere, and I paid it off. So I'm saving $1,000 a month right now, if I look at it that way. So I'm one of the lucky ones. But a lot of people are struggling because what happened was the people who refinance or had the HELOCs or other loan that is not fixed jumped. And then the property rates jumped, and the insurance jumped, and your cable costs jumped, your lattes jumped, your gas jumped. And all of a sudden, people are pulling their hairs. And you mentioned $100. To some people right now, $100 savings is a lot of money. Right? I mean, my mortgage payment is close to $3,000, so $100 ain't going to do much. But for people who are in trouble or who are in a situation, $100, $50, it helps a lot. I'm not going to lose my house, or those people are not going to lose their houses or whatever, you know. So we are hoping that rates drop. But what I want to bring up and discuss further, and by the way, for those of you watching, thanks a lot for watching, coming back. If you're live, if you have any questions for me or for Kevin, or if you have any comments, please mark it or comment. We'll try to answer it. And if you're watching a recording, a lot of my viewers watch this as a recording. And if you have a question, jot them down, and I'll be sure to answer those questions. So what I want to discuss is what will be the impact? There's 3 scenarios. So I'm going to go to the add another screen here. Okay, I'm going to stop one screen and start another screen from bank rate. Let's see. And this article, mortgage rates scenario to watch following a likely Fed rate cut. Guess what? This is from yesterday's article at Bankrate. I'm sure, Kevin, you watch this website all the time. But want to discuss 3 things. They talk about 3 scenarios. But before I do that, I want to read the first couple of sentences to see what makes sense. Nearly everyone thinks the Federal Reserve will cut interest rate this week, which is tomorrow. That sentiment has translated to falling mortgage rates. Last week, the average 30-year fixed dropped to 6.38%, according to Bankrate's national survey of lenders. Rates haven't been this low in nearly a year, which you already mentioned. These lower rates reflect growing market optimism that the Federal Reserve is likely to cut rates at its next meeting on September 17th, with further cuts expected through the end of the year, says Samir Dedia, CEO of One Real Mortgage. So let me see here. I wanted to read one more thing here. Let me jump on this paragraph. But if the Fed does cut rates by a quarter point as expected, that will happen to mortgage rates. What will happen to mortgage rate? It's not an easy question to answer, but here are some scenarios on how things could play out. So what I want to discuss, Kevin, is like Bankrate is giving 3 scenarios. What if the mortgage rates rise instead of dropping? So what they're seeing is in mid-September 2024, the average rate on a 30-year loan was 6.2%, according to Bankrate's national survey. Then the Fed cut rates at 3 meetings in a row, cumulatively, lowering its benchmark rate by a full percentage point. How did mortgage rates respond? Well, they defined the Fed they defied the Fed and shot up, rising above 7%, which you mentioned earlier as well. That was back in um, about a year ago. So could that happen again? Who knows, right? I mean, it's not all, doesn't look all rosy to me.
Right.
Because the reason is because you mentioned earlier that because the treasury went up or down, I'm not sure which one you mentioned, the lenders have already dropped the rates. So if
Right.
they drop quarter point tomorrow, half a point, or 3 points, good luck. It could go either way.
Yeah, it could. So last year, I think the possible effect may have been because remember we were in an election. So typically during election times, when it gets closer and closer to selecting a new president, things begin to tighten up.
Right.
That's what I think possibly happened. No one knew who was going to win, or so people just kind of like, let's tighten up. There was a small window of opportunity though, like from that rate cut in September to October. There was maybe it was 2 or 3 week window where you could have probably got the best rate you could have gotten in, I think, 22 months. So the problem is people trying to time the market. And when I say they're trying to time the market, okay, rates are the lowest they've been in 12 months. I'm going to see if they've been the lowest they've been in 24 months. And then boom, we back to 7% FHA. Conventional had got close to 8%.
Yeah.
And then people were discouraged. And no matter who became president, their change doesn't happen until they take office in January 21st, January 21st.
Right.
No matter what side it is. And I don't think that people thought that rates would still be where they are now. I think people thought they would immediately get into the fives, which creates another problem, Mike. What people don't understand is, in my professional opinion, right now is kind of the perfect storm. You have historic interest rates. Rates are where they historically have been and should be, right? But you also have, in our market, in markets across the U.S., I'm not sure about California, we have 4 to 5 months of inventory, which means it's a moderate to a buyer's market. And what it is, okay, now I have the opportunity to get a decent interest rate. I can get an offer, put in an offer with a seller. And if I'm the only offer or one of 2 offers, I can negotiate some closing costs in. Maybe the seller can contribute, instead of them dropping their price, they can contribute that $10,000 to me buying my rate down. I got one right now. The seller gave $10,000 in closing cost assistance. The buyer applied that to buying their rate down permanently, not the 2-1 buy down, to buy their rate down permanently. So she's getting a 5.875 interest rate instead of lowballing the seller. So like those are scenarios that you get. If rates get to the 5s, we're going to have a war again. When I say war, bidding wars.
Multiple offer wars, right?
Offer wars. And then the pricing of housing now, and thinking you're going to come in and offer the seller $20,000 less and then ask for $10,000, in the seller's mind, that's $30,000 I'm off. You're not even going to be able to get in the highest and best because somebody's going to offer over. And then guess what? Housing prices go back up. And sometimes it doesn't matter what the rate is. If housing prices go up and you have appraisal waivers, where you're waiving contingencies and all the things that went on. So this right now, I think this is probably one of the better times in the market to buy because you can negotiate with the seller and get some of what you want because they have a place they need to be. And like this specific time of the year, Sellers are looking to get out of their house so they can be in something new for the holidays, and buyers are looking to do the same thing.
Right. Absolutely. Yeah. Yeah. I mean, if the rates drop significantly, and I don't know what significant is, half a point, and I'm talking about the mortgage rates, not the Fed rates, it may create housing wars, multiple offer wars again. So let's see what happens. There was a chart that I want to read out um, to see how that'll happen. This chart or article is from the National Association of Realtors, came out a few months ago. It's saying, right now the affordability is very low, right? It's been the lowest in 25 years. In the last 40 years, according to Lawrence Chun, the NAR chief economist for the NAR, National Association of Realtors, the affordability has been the lowest in 40 years, not 20, not 10, 40 years. So, and one of the reasons is because high home prices and higher interest rate. And when I say high, it's comparative, right? It's high compared to 3% 4 years ago, but it's way low back in the 80s when it was 12 to 18%. So it's relative. But here's what the research showed. When the rates drop to 6%, 5.5 million more households will be able to afford a home, which means there'll be a whole influx of buyers. Not all of them are going to buy, but a lot of them will buy. Not 5 million will buy. It also says that 550,000 people will likely buy within 12 to 18 months. So that's a 500,000 homes. And this year, we're going to sell about 4 million homes, which has been the lowest in the last 25 years. So when the rates drop and there's 550 more homes selling, that's going to create a frenzy of houses because there's a shortage. So it all ties in. I mean, that's why I guess people are watching on what's going to happen with the interest rate. Are they going to go up? Are they going to go down? And we're talking about the mortgage interest rate. And we won't know that until how long does it take for the rates to go up or down after the Feds announce the rates? Is it instantaneous or what? Any idea on that?
I know last year when they dropped the rates in October, not the September time, but when they dropped them in October, rates went up that day. Like,
Oh,
so
it's
we get indicators. It depends. It really depends on the market. So we get indicators throughout the day. There's been pricing improvement. There's been pricing has gotten worse. And I
okay.
remember last year, I felt like every other hour I kept getting an email that said pricing had gotten worse.
Right.
So like it could take effect immediately. It could take effect in the morning. The markets may do
Okay.
something funky and it'll happen in the morning. And, Jerome Powell will come out and say we're dropping rates, and, it may not do anything. Like in September, it didn't do anything. We had
Right.
already hedged for it. But when they dropped it in October, we
Right.
started to see it, changes. So
Yeah.
the it's so finicky, man. Like I
Yeah.
saw a bunch of price improvements over the last 2 days.
Mm-hmm.
Um, so that could be hedged ahead of the announcement we hear tomorrow, and we may not see a change to mortgage interest rates.
Right. Right. Okay. Well, let's take a look at scenario number two. What if the mortgage rates stay the same? And this is according to bank rate as of yesterday. Let me read out a little bit here. Um, Perhaps history, let me make it bigger a little bit. Perhaps history doesn't repeat itself. Maybe mortgage rates settle into the range of 6.25% to 6.5%. That would be a welcome relief from a recent run of elevated mortgage rates. They briefly hit 8% in 2023, then spent stretches of 2024 and 2025 above 7%. In this scenario, mortgage rates enter a holding pattern, and as the market makes sense of conflicting economic data. I'll read one more paragraph here. A 25 basis point cut is almost a sure thing, and the market has baked that into the current rate level, says Sean P. Salter, an associate professor of finance at Middle Tennessee State University. I look for rates to remain in the current range until we get some better idea of the true state of the US economy. So the scenario two could be, hey, they may not change it. Then what happens? Nothing's going to change. The affordability stays the same. The buys are not going to budge. I guess the morale will go down.
So yeah, so it those who are going to buy are going to buy. Like for instance, Mike, if you decide you want to downsize because you just have too much house, you're probably not going to wait until rates drop.
Mm-mm.
If you need to move in a parent or in-law, you're not going to say, I'm going to wait till they get to 5%, then I'll move mom in. Like, you're going to make a move.
Right.
If someone has a baby, they're not going to say, oh, let's wait till the baby's one and get another house and they're in a 1-bedroom apartment. You know what I mean? Like
Right.
those things people are going to buy.
Right.
I I think that the people who a lot of the sales that are not occurring and happening aren't just buyers not buying. I
Mm-hmm.
think that it doesn't make sense for some investors to invest, which
Right.
is a part of the market.
Yep.
And the people that are waiting for the pie in the sky are waiting for the pie in the sky. I mean,
Yep.
when during COVID, when rates were 2.75, 3%, I literally had people say I'm gonna wait till they're 2 or 1%.
Wow. Yeah. Yeah.
So it's never gonna be enough. It's
And
never
those
gonna
guys
be
are
low
still
enough.
waiting, right? Those guys who waited for 2.5, 2.72 are still waiting and should I say crying? They
Yeah, I had one
didn't
come
say that.
back.
Sorry, I'll take it back.
I
But I
had
didn't
one
say it
person.
officially, so
I had one person come back and look, and they were two things. They was like, my payment is way more than what it would have been in 2020, 2021. And I'm looking at the same house that's $150,000 more. And I say,
wow,
yeah,
it's amazing.
like you're looking at the same house. Yeah, you increase
Yep.
price range because you got a raise or went on, increase your score and rates are down a little bit, but you're still looking at the same style, same
Right.
type houses just for
Right.
more money.
Right.
Um,
Yep.
so yeah, in that case, yeah, the morale goes down.
Right, right. Hey, we have a lot more people who joined us. So, hey, thanks for coming on board. If you have any questions or comments, please make them and we'll try to address them. But I want to get back to the scenario number 2 from Bankrate and finish what I had started. I want to read out this quote, starting with much of the recent decline in mortgage rates was spurred by the jobs report that came out in early September. It's unlikely that the Fed's move will lead to further decline in mortgage rates, says Phil Crescenzo Jr., Vice President of Nation One Mortgage Corporation. And the quote is, I think the savings is built in for the most part. We've seen most of it. We shouldn't be thinking mortgage rates are going to plunge into the mid fives. I kind of agree with him. They're not going to drop. I know the Trump administration wants the Feds to drop 3 points, let alone a point, a quarter, or half. But if it doesn't drop, what's the scenario that could happen, Kevin? What, as far as buyers goes, what should they anticipate if it doesn't drop? It'll drop in October, December.
I think that they should utilize the strategy I just said of negotiating with the seller and utilizing that to take care of a permanent buy down
Mm-hmm.
or utilizing it to take care of their closing costs because there's still an opportunity to negotiate, you know. So I talk to people in different parts of the country.
Okay, so let's talk
New
about. Go ahead, finish up. I thought, yeah, go ahead.
so New Jersey, um, as they call it, South New England area, they're still having bidding wars.
Mm-hmm.
Delaware cooled off. Georgia, certain parts have bidding wars. So no matter what, I said all that to say, no matter what the rate is, certain pockets of the country are going to still have hot markets,
Mm-hmm.
and certain ones are going to be stagnant.
Okay, so I want to bring something up because you talked about rate buy downs. We all know that in a lot of states like Texas and Florida and other states, I haven't seen that in California. In some areas, yes, in Southern California, some areas, but a lot of the builders who got stuck when the rates went up, when the cost of living went up, when the home prices went up, a lot of the buyers pulled back. So the builders got stuck with a lot of inventory. And what they did, not only give them closing cost and free upgrades, put a granite counter or put an updated tiles or whatever, they also gave them 2.99%, 3.9% interest rates, right? Did that help sell those new homes, or how did that impact? I'm not sure if you're aware of that or not, but I know they were giving a lot of incentives to push the inventory out.
Right. So Lennar had a report out last year that 12.5% of their profits went to incentives. That's a
lot.
huge portion. That's a lot, right? So what we have to kind of look at is right now, I just had a conversation with a lender friend of mine who works for a builder. And I said, hey, it looks like these builders are getting aggressive. And he said, no, Kevin, we're getting desperate because we've got inventory setting. And when it like some builders in our area are offering a forward commitment of 4.99% interest rates, which they paid for in advance for the life of the loan. And they have also given $7,500 to $10,000 in closing cost assistance on top of the already low rate. And then some builders are offering $10,000 bonuses to agents, 5 and 6% directly to the buyer's agent. Like they're giving a lot of their profit away to move inventory. So yeah, they've got pent up inventory, and with us going into the fourth quarter, you'll see probably even more fire sales.
Yep. So if you want to buy a brand new home with a lower interest rate, you may have to move out of the area. Like if you're in California, you ain't going to find that. But I know a lot of states, specifically DR Hortons in Texas, is doing it all day long, right? Lennar in Florida is doing it. They're giving a lot of incentives, a lot of rate buy downs. And just to clarify, these rates we talked about 3.99 or 4.99, those were fixed rate, not adjustable rates, right? Those were fixed.
Yep, those are fixed rates. Yep.
Because that makes a big difference because, after 7 years, so those were fixed. I want to go back to scenario number 3 from bank rate and complete that process here. So what happens if the mortgage rates fall? And everybody's expecting this. So if the rates fall, hopefully you can read a little bit better, but I'll read it out. So the scenario is the rates will fall. Another possibility, and one that loan officers and real estate agents are hoping for, is that mortgage rates keep falling and that the Fed keeps cutting. It's a be careful what you wish for scenario. Mortgage rates generally rise when the economy is revving, and they typically fall when the economy begins to sputter. So declining rates would probably follow continued weakness in the job market. I'm going to read further. Rates at 6% or below wouldn't be bad news in certain corners. Some discouraged home buyers could decide to get off the sideline and resume their home searches. And some of those homeowners who took mortgages at 7.5% could refinance into cheaper debt. I'll let you say what you want to say on that scenario. What's your take on that?
I think that scroll back down. There was a section in there that I wanted to read again. Scroll back down for me, Mike.
Number 3. There you go.
Scenario number 3.
Okay. Let me make it bigger. Oops. Oh, that went too big. Sorry.
Yeah. So like, even I think the statistic is even if interest rates get to 6% even, that brings in 1 million more home buyers.
Yeah.
And
potential home buyers.
Potential home buyers. Yeah. 1 million more potential home buyers, which again takes us back into bidding wars in certain parts of the country. I think that if rates fall, I think they probably won't see much of you and I on YouTube for one thing, because we'll be super busy.
Yeah, exactly. Right. Absolutely.
But then it's a catch-22 because I think people will find out that they're going to need more money than they needed before, because now sellers aren't paying closing cost assistance.
Right.
Now sellers may not accept the contract that has down payment assistance.
Mm-hmm.
To win that bid, you might have to go 20,000 over. So when it says be careful what you wish for, really be careful what you wish for.
Right.
Yes, we want lower interest rates, but I think people forget that the difference between the crash in 08 to 2012 and now is they had oversaturation of inventory. Right now we're under inventory, so that's why you still see some bidding wars.
Right. Okay. So I want to switch gears a little bit. I mean, it's not really switching gears, but we want to look at, we've talked about what's going to happen with the buyer, but let's talk about what will happen to the sellers. So as you know, I just want to give some stats to our viewers here. A lot of the sellers, in fact, this year, 40% of all the homes that came on the market, 40% of the sellers delisted their home. That means they canceled the listing or decided not to sell and let the listing expire, which we call delisting. It's no longer on the market. And one of the main reason is because the sellers are saying, look, if I don't get the price that I want, if the house down the street sold for $1 million, the sellers still think the market's going up. So they want $1,050,000 or $1,020,000 or 1.1. In some areas, if the house sold for 400, they want 420. So they're not getting the price because buyers are not paying them and buyers cannot afford it. So what's happening is a lot of the homes that came on the market in an already short inventory housing market, it's even reducing it. But what this article says, let's look at what this article says rather than me saying it, is a Fed rate cut could ease the lock-in effect. What that means is, let me blow it up a little bit. Falling mortgage rates could prompt more homeowners to list their homes for sale, boosting housing supply. The lock-in effect has many homeowners holding off on selling their homes. In the US, nearly all of the 50 million active mortgages have a fixed rate that is far below prevailing mortgage rates, which creates a disincentive to sell, the Federal Housing Finance Agency found in a study published in March. For every percentage point that the market mortgage rates exceed the origination interest rate, the probability of sale is decreased by 18.1%, the FHFA said. Let me read out the last paragraph and then we'll talk about it. Home prices have increased as a result of demand staying put, while the supply of homes for sale dropped dramatically and still going down. The supply reduction increased home price by 5.7%, outweighing the direct impact of elevated rates, which decreased prices by 3.3%. But a big drop in mortgage rates could entice some homeowners to sell. So that's a pretty interesting article, because if the rates drop, a lot of sellers will put their home on the market. And like, I have a 3% mortgage rate. If I was thinking about selling, I'm thinking, why would I pay 7%? I have a 3%. But if it drops to 5.5 or 5.99999, I may think about selling. So I guess that's a good thing for the sellers, or is it not?
I think it could be good for the sellers because realistically, even though they've got a 3.5% interest rate, they're trapped in their home, and they may not be the home that fits their needs right now. They, the other thing in terms of, I guess it would be homeowners and not necessarily sellers.
Right.
If rates drop to 5.99%, 6%, it could make sense for them to refinance to get rid of some consumer debt that they've racked up.
Right.
Because of whatever happened. So they'd lose that rate, but they wouldn't be refinancing from 3 to 7. They'd refi from 3 to 6 and take that hit in their payment. But overall, they'd cash flow better. So those are or they could say, hey, I can probably find what I need. It's a little higher payment, but I can get the house that I want. So it just gives them more options, and it could bring more sellers on the market with more inventory.
Right. One thing I would tell the sellers, not that I'm talking to a seller, but if I was talking to a seller, I would say, look, Mr. and Mrs. Seller, you bought the house 5 years ago, 7 years ago, 10 years ago, in my case, 20 years ago, and it has doubled, tripled, or quadrupled, right? I refinanced, pulled some money out, bought a boat, remodeled, took a cruise, blah, 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 right? Now it's time for me to sell because I want a single story home, or I want a bigger home, or I want to go near my grandkids or go towards my grandparents. Yes, you have 3%, and yes, you'll pay 6%. But think about it. You paid 500 for the house and you're getting 800 for it. You can take that $300,000 minus your capital gains tax, if you have any taxes, commissions. If you put that chunk down, you're still going to reduce your payments. At some point, you got to give, right? You can't just say, oh, no, I got 3%. I won't buy at 6%. Well, you're gaining $300,000. I've sold homes for $500,000 10 years ago, and they're worth $1 million. If he or she sells it and tells me rates are 6%, I'm going to give them a slap, because they're my good clients. So I can do that if I had to. And I don't mean a physical slap. I meant a mental slap. You idiot, you're gaining $500,000 and you're crying about 6%. You're complaining that this house is small and you want to buy a newer home. Don't let that interest rate stop you. And if you buy at 7%, if the rates do drop, you can always refinance. So you have to look at the whole scenario, not just the interest rate. Don't look at one thing. Look at the whole scenario. If you buy, will you have a better lifestyle? Will you be getting a big chunk of money that you can put as a down payment? I mean, you can't just look at one thing and decide a factor. And that's what a lot of the buyers are doing, and that's what a lot of sellers are doing. I mean, that's my opinion. Am I just blurbing out, or what do you think?
No, I think you have a great point of view. I think that oftentimes people look at their house as a bank. They want to get the most money out of it, but want to pay the least to get that money. And you're right. You're walking away with $300,000 instead of thinking of what we can buy to furnish the house. Let's have a strategy on how we can get our payments a little bit closer to where we want them to be by utilizing some of those funds. Mm-hmm. Sometimes that's putting 20% down. That's sometimes putting down 10% and buying the interest rate down so you have a greater impact. Right. I did a scenario with a client yesterday. Mm-hmm. I've been working with her for a good week. Okay. And she insisted on having her payment at a certain price point.
Right.
So I showed her, I do a Zoom with my clients when I meet with them. Mm-hmm. And so they can see what I'm talking about in real time. And she was like, oh my goodness, but that's not where I want to be, Kevin. What if I put down $10,000 more? So it's like, okay, here's what it looks like. If you put $10,000 more down, this is what it looks like if you can buy the rate down a little bit. Buying the rate down a little bit had a greater effect, but it still didn't get her payment where it needed to be. Mm-hmm. She said, what if I put down 10 more thousand? I showed her, this is what it looks like to put down 10 more thousand. It saved her $58 a month. And she said, cool, well, my payment's where I want it to be. And I said, hey, can I show you something? Mm-hmm. And she said, sure. I said, let's take that $10,000 that you want to put down and divide it by $58 that you'll save a month. It would have took her 173 months to recoup that $10,000, saving $58 a month. And she said, I could put that in the market and have the potential to make more than saving $58 a month. I said, yep. Exactly.
Exactly.
And I told her, what's your concern? That I won't be able to pay my mortgage payment. And I said, if your money is tied up in your house, you're still not going to be able to pay it no matter what the payment is.
Right.
And exactly. She was like, I never looked at it that way. So yeah. I think she's going to be close to where she wanted to be.
Right.
She's buying down the rate as far as she can buy it. And she's going to put down 20% so she doesn't have mortgage insurance. But she's going to keep that other money instead of trying to save. It ended, the 20,000 ended up saving her like $116 a month. Right. But she was like, I could make more money, and $116 isn't going to stop me from a catastrophe if something were to happen. So, that's what the other thing. People want what they want, but sometimes you have to be advised what makes more sense.
Right, right. I'm going to take a poll in a minute and also give you results of a poll I did on my YouTube channel. But we have a comment from Alfred. Thanks, Alfred, for watching, and thanks for your comment. He's saying, and if their primary, which means if it's their primary house, up to 500,000 tax exempt for married folks. Absolutely. So what that means is, if I bought my house, or if I sold a house to a client for $500,000, if they sell for $1 million, and if they're married, at least I think this is nationwide, then on the $500,000 gain, if you're married, you don't have to pay any taxes up to $500,000 gain. That's absolutely right. So all the more reason not to wait for interest rate to drop. Buy, because you have $500,000. Of course, you have to take out your moving cost and closing cost and commissions and attorney fees and title. But even then, it's still a $500,000 gain, which you're not paying any taxes on. And then you're crying about a 1/8% point and not moving and staying in that house that you don't like anymore. So think beyond interest rate. Think, open up your minds, talk to realtors, talk to lenders, talk to your accountant, talk to your financial planner. And if you want to talk to any of these people in your local neighborhood, I have contacts and connections and a network with top agents, top realtors, top accountants, and I can refer you to them, talk to them so they can guide you and you're not stuck in the way you think. And I'm not saying you're thinking right, but when you talk to a third party, they'll open up your thinking and your options. Like Kevin was saying, that lady, the $58 did not make sense at the end of the day. So thanks for the comment. One thing I want to go back to is, I'm already sharing the screen with you. Let me see here. Market Watch, where is it? So a Fed cut rate could boost home building. As we know, the home builders cut back because the market slowed down and a lot of the buyers were not buying. A lot of the builders cut back. Instead of building 500 homes, they built 100 homes. Instead of building 100 homes this year, they put it on hold. In Florida, they can't build homes because there's no workers over there. So that's a whole new story, but that has a big impact on the housing industry. A lot of the construction companies have closed because the migrant workers, whether legal or not, they've been out, or they're scared, or they ran away. But it's a true fact that housing construction in Florida has a big impact because of the mass immigration deportation or whatever. And this is not a political, it's a fact. So I just want to clear it out. So if the Fed rate cuts, if the rates are cut tomorrow, falling interest rates could also prompt more home builders to start new construction as borrowing costs fall, which then lead to an increase in housing supply. It's all about the supply. With the lock-in effect constraining the supply of previously owned homes, many buyers have turned to new construction. But over the last 2 years, builders have been broadly slowing down construction of homes, as seen in the chart below. So let's look at the chart. Let me make it bigger. So this shows thousands of units built. And you can see in 2024, the peak, there were almost 1.5 million homes being built. Look at what's happening right now. Way down. Look at the drop, a huge drop. To read further, the slowdown is due in part to higher interest rates. Carl Harris, the chair of the National Association of Home Builders, has said builders are grappling with elevated rates for builder loans. Harris, a custom home builder from Wichita, Kansas, said in a statement in mid-August, builders are also dealing with shortage of construction workers. I just mentioned that, as well as dearth of available lots on which to build homes. So this does not affect just anybody or home sellers. It affects the home builders, the new home builders. And a lot of the buyers would like to buy new homes, especially with all the incentives, Kevin, that you talked about, right? Leonard gave away 12% of their profits into this. So do you see a big impact coming on home builders, or is it just you know?
I think it could under normal circumstances. But two factors that I'm not sure if the person who wrote the articles thought about, tariffs and what you just mentioned about workers and ICE. I've talked to a couple of people who are builders,
Right.
and their cost has increased. Like they had estimates on jobs that they were going to do. And because, in certain parts of the country, ICE has come through, they had to, and they don't have their workers because, like you said, they're either gone or in hiding. They are having to get with people who are part of labor unions, and they want more than our, Hispanic brothers and sisters were willing to build for. So
Right.
that increases the cost, and the cost typically gets passed off to the borrower. I've also seen where builders have made adjustments with trying to figure out, okay, how do I offer these incentives and how do I keep housing prices within a certain point? And they're taking away square footage.
Ah, you mean they're building smaller homes?
Smaller homes, yeah. Yep.
And are they charging
Smaller
the
homes.
same, or are they charging more, or?
Trying to stay as close to the same as possible. But for, let's say in Georgia, for a $350,000 house, which probably could have been 2,700 square feet, now it's probably 2,200.
Huh.
They're taking, instead of those bedrooms being 12 by 12, now maybe they're 10 by 10. Maybe it's instead of having the 2-car garage and like a bonus area off the garage, maybe it's just a 2-car garage. So maybe instead of having, like in Georgia, they had this thing where instead of having closed off kind of space, they made like an entertainment room upstairs, like a loft. And I haven't seen many of those lately. So they're taking away and they're using, okay, we'll put bedrooms up here, smaller footprint. So we're going to utilize all this space. Closets are smaller. Like you're seeing a lot of changes.
Right. And one of the things I've noticed, because I go on YouTube a lot, because I do videos, and you can always visit my channel, Home Savvy Central, and Mike Moves You. But one of the things, and you're absolutely right, the other thing that's happening, I didn't know that they were building smaller homes, but guess what the builders did? And guess why they have a lot of lawsuits, especially D.R. Horton in Texas and Lennar in some of the areas. In the last 2 or 3 years, because they had to cut cost, guess what builders did unknowingly to the consumers like you and me? They did 2 things. Number one, they used cheaper material and cheaper labor. So in the history of new home building, right now, there are so many issues with construction defects. Air conditioning is going bad, leaks in the bedroom from upstairs to downstairs, dishwashers not working, pipes bursting, literally bursting. And I'm talking about slab leaks.
Wow.
Showers leaking. Because guess what? You mentioned there's a shortage of supply of labor. Guess what? They hire anybody they can. They hire a guy like me who can't even hammer a nail into something. I hurt my finger doing that. And when I put that nail in the drywall, it's not probably, it's going bent. So what has happened is not only have they made them smaller, they made them cheaper and less quality. And that's a fact. If you look up, I won't say, but go on YouTube and type in new home construction defects. And they're having a lot of issue, a lot of lawsuits. They've never had so many lawsuits. You can see videos all day long on it. So there's several things happening behind the scenes that we're not knowing, and will come out in the next couple of years. A lot of the home buyers are really mad, specifically D.R. Horton in the Texas area, because I was talking to a realtor who did videos on those on the builders, and they were not happy at all. And when I say they, I'm talking about the home buyers. They've moved in, and the day they move in or the second day, they see roof leaks and shower leaks and things happening, so all kinds of things happening.
Wow.
Have you heard anything like that in Atlanta area?
Yeah, we've seen we've seen our share of issues in terms of ceiling leaks, sewage backups in the bathroom. I just so happened to see a social media influencer who they moved from one place to Texas, and they had mold in their bathroom. And, of course, you get it cleaned up and then the mold would come back. And he said, well, it's right around the tub area. And he said, well, let's get somebody to take up the tub and see what's going on. They took up the tub. It was all mold on the inside.
Ooh.
There was Coke bottles, potato chip wrappers, candy bar wrappers inside. And not just only that. So, there's a specific type of drywall that you use in moisture areas that's green. They use regular drywall.
Yep, cheap material, cheaper
Cheap
material.
materials. Yep.
Yeah, it's happening. It's happening. We're not just saying things. I wouldn't say things if I wasn't sure or if I didn't read a report on or heard somebody reliable. So when we say these things, we don't just say it. We mean some of the things we mean to the best of our knowledge. Of course, we're not 100% accurate, but we try to give you as much information, as much accurate information, share what's happening out there. At the end of the day, you're a buyer, you're a consumer. You have to make your own decision on buying, selling, getting a loan. That's why I recommend talk to your lender, talk to your realtor, talk to your financial planner, your accountant, your attorney, and make that sound decision. I'd rather talk to somebody, pay a $1,000 or $2,000 than buy a $400,000 home, stay out in a hotel for 2 months while they're doing this mold issue. And there's one lady that I saw a video of. They've been 18 months on a lawsuit with a builder, and the insurance is not paying them to stay outside because there's mold in the house. They had to move out, and the insurance only covered 3 months of coverage. So they actually rented a trailer. These are people who are like accountant or somebody staying in a trailer. They don't have any money. So things happen. Things happen.
That's crazy.
Yeah. So let's switch gears here and look at this report from Market Watch. It says that the housing market still faces a considerable shortfall in supply. Everything is on supply. People tell us, well, the prices are going to drop. It ain't going to drop if the supply don't go up, period. Right? There is no night. If there's no day, there's no night. There's no night if there's day. So unless the housing inventory goes up significantly, we're not going to see any price drop. It's just the way it is. So let's see what they say. A drop in mortgage rates won't solve the housing market supply problem overnight. Kathy Bostancic, chief economist of National Mutual Insurance, told Market Watch, "It's tough because it's not just about interest rates," she said. "Even if mortgage rates come down, we're still going to have a housing imbalance between demand and supply. In other words, a drop in rates could release more demand while supply continues to lag behind," she said. I'm not going to pronounce her name, so I'll skip it. Residential mobility is very much tied to life events like people moving for jobs, having a child, getting married. Oprah Devon, a senior economist at Zillow Home Loans, told Market Watch. So I'm not sure that there's a magic mortgage rate that will unlock the housing market. I'll read that further, but what's happening in your area in Atlanta as far as inventory goes? Because you mentioned there's sales out there, but what's happening with the inventory?
Yeah, so we're in such more buyer's market. We have more houses on the market than we have buyers looking right now. So it's and again, it's in certain parts. Like I'm in what you consider Metro Atlanta. There's a part of Metro Atlanta called Alpharetta where I spoke to an agent and she said there's still multiple offers. But if you move to Alpharetta, you have money.
Alpharetta is like tech company, right? All those people who made money in stocks, those guys are buying, right? All my friends who work at Microsoft and Google and Nvidia. So that's not a normal thing. That's
Steve Harvey, Tyler Perry, those people live in
those
Alpharetta.
people. Yeah. So what's happening around Atlanta, like 20, 30 miles out? There's a lot of inventory out there. What about comparing new and old inventory? What's going on there?
I think new construction has slowed down some. I think resales are picking up some. Like I've had clients who didn't want to touch new construction because they see the reports as well of the quality of construction. And they feel like, hey, had one person say, I feel like I'm in the Truman Show. It was a show where Jim Carrey lived in a development and all the houses looked the same. So they'd rather have something that was lived in and it fit their needs. But, in certain price points, there's still multiple offers, anything under maybe 300, 325,000. Then you don't have problems, so to say, in 800 on up, because those people are going to buy. But I will say one thing about our market that I noticed. I'm not sure if in California, but in Georgia, there was a big craze about large houses, maybe 7,000 square feet, that were all white with black trim or wood trim. We loved it. Me and my wife loved it. Thought about painting our house that color and making those changes.
Uh-huh.
And then all of a sudden you see them everywhere. But now it's so many of them on the market.
Really?
And I think it's because people didn't realize $1 million house has $1 million problem. Like, I mean, you can pay the mortgage, for $8,000 a month, but your utility bills are higher, landscape is higher, and, everything is higher. And it's like, okay, maybe I don't want this $1 million house anymore. It's quite a few of them that have been sold in probably the last 2-3 years that are back on the market.
Are these millennials, high-tech people? Who are these guys and why are they selling? It could be because a lot of them are being recalled to the company to work physically.
That's a good question.
That's happening a lot.
That part I don't know.
Okay.
I don't know, but I just noticed that when I ride through my area, I see a lot of those houses are back on the market. Yeah.
So the inventory is higher and it's taking longer to sell, right? In Atlanta.
Yep, inventory is higher and taking a little bit longer to sell.
Have you seen a price drop yet, or?
Yeah, we've seen price reductions. It's had a couple that went under contract. I think the house that they were initially looking at and wanted to offer on, it dropped $20,000 before they made an offer.
Okay.
Yeah, and I mean, we're talking about a $300 and some $1,000 house, so we're not talking about $1 million house dropping. I've seen my agents go in and negotiate 30,000 off. Like, it just depends on. So these are depending on the situation and the seller. But then I'm also seeing houses that are just the prices are dropping. 10,000, 20,000. Constantly when you see Zillow say, hey, 123 Main Street dropped $20,000.
Right.
Because they're trying to get rid of it for some reason.
Right. And that's why a lot of the sellers are delisting, because they're still stuck in a nice way. They're still stuck that, hey, he sold for $1 million. I want $1 million. But hey, price, depending on your area, the situation has changed. A lot of the people, like in some areas in Southern California, a lot of millennials bought. A lot of them are being called to work, or one of them lost a job, especially in high tech, and they can't afford it. In Southern California, if you buy a newer home today, your mortgage payment is $5,000. That means you're going to make $15,000 to qualify for a home. And if one of you loses a job, they're in trouble. So let me see here. We got a comment from Adrian, black window, white paint. I'm assuming he's talking about homes in Atlanta. Adrian, thanks for your comment. I don't know what it means, but maybe you want to specify. But
yeah, that's what he's right. He's got the little trash can next to it.
Oh, I didn't see that. Okay, black window and white paint. Okay, that doesn't look good. Yeah.
They've got the black window trim and the white brick
you're
paint.
kidding.
So
and a lot of homes have that. I wonder who came up with that idea. So
it was nice at first, but now you would see one here, one there. Now, like in certain parts, it's like just a whole row of them.
Right. Okay. Well, I want to ask a question, and maybe you can write it if you're watching live. Make a comment, or maybe after the video on the recording. If you're a seller, the question is, are you asking yourself, should I wait or sell now? And if you're waiting, let us know why you're waiting so we understand what's going on. And if you're a buyer, and if you're telling yourself, should I wait for the rates to drop or home prices to drop? What's making you wait, or why would you wait? After this live, or even during the live, make comments. We want to know what's going on. So the next time we do a show like this, we can use that information, because what's happening in California, what's happening in Atlanta may not be happening in Texas, may not be happening in Florida. Florida is a whole new animal by itself. What's happening in Florida is sad, but it's good to say that it's coming out of its downfall, where there's lots and lots and lots of vacant homes, lots of homes on the inventory, lots of them have already sold because a lot of investors, sharks, contractors, developers bought them cheap. So the inventory is lowering, but still very high. So let us know what's going on. And if you have any questions or if you want information about Kevin, if you go to my description on my YouTube channel, his website is there, or at least his YouTube channel is there, and his information is there. So hit up Kevin or myself. I'll be glad to address any questions or concerns with you. So with that, any last minute thoughts, Kevin, and then we'll call it a day.
Yeah. As I always say, if you're in the market or you're looking to see what it takes to purchase a home, instead of speculating, just apply. That'll solve a lot of your problems. Guessing, listening to CBS or ABC or 123, trying to figure out what makes sense. Get with a professional lender, get some questions answered about your specific situation. Then when you finish, they'll refer you to Mike and he'll find you your house. But Mike's not going to show you a house unless you got pre-approved.
Of course, I wouldn't get in my car. Get out of my, not that we think I'm in the cars, right? But one thing I would say is, if you're a buyer or if you're a seller, what do most buyers and sellers do? They chase the market. Please don't chase the market. You don't know when the market's going to hit bottom or when the interest is going to get bottom. I mentioned HES earlier. Maybe I did not. It's a home economics survey. This is a survey done by top 100 gurus, Mortgage Bankers Association, Wells Fargo, Fannie Mae, Freddie Mac, Morgan Stanley. All these guys do a survey, and they're wrong many times. What makes you think when you buy 1 or 2 homes in your lifetime that you're going to hit it right? I'll leave you with that. Don't chase the market. Thanks, everybody, for watching. Thank you, Kevin, so much for coming on. I hope I can call you again. You can come on board, and maybe we'll talk some good news about lower interest rates.
Yeah, I'd love to, man. Appreciate the opportunity.
Okay. Thank you all for watching. And please visit our channels and hit us up for any questions. Thank you.